going to follow a similar format we did last time, where Chuck's going to bring us through a high-level summary. Then Mark's going to bring us through his section. And then Chuck's going to go through his views. And then at the end, we'll have a general Q&A section where you can, we'll just have an open forum where you can go ahead and unmute yourself as a preferred method when you get to that section, ask your questions, and we'll just have a dialogue around what we're currently seeing. So with that, Chuck, why don't you get us going?
Okay. So it's actually a relatively quiet month. You're going to see that as a theme as we go through markets for the month. And July is typically one of the quietest months of the year, and August is assumed to be a quiet month, but August is sometimes the month of absolute chaos. And so we'll be talking about that as well. But as we come into this month and we look at the markets in play, basically a couple of the big themes are the dollar, which is a relative strength leader, and the euro, which is a relative strength laggard. And we're going to talk a lot today about weakness in the euro crosses. And you can see in FX Spot, we have a number of euro crosses, euro dollar, euro Aussie, euro CAD, euro Swiss, that are all relative strength laggards to the downside. And we have British in there as well, the sterling CAD, sterling Aussie, sterling Swiss. And then we have wheat is weak on the downside, and hogs, which are strong to the upside. So, looking at the changes in the last month, if we look at the three biggest up moves in terms of relative strength were in the Russell, the NASDAQ, and the E-mini, all correlated and all coming off the bottom. And the weakest were crude, dollar index, and the two-year note. Two-year note was basically unchanged. So, really more upward strength. And we can see that in here. You can see in the net changes for August. You can see the indexes were quite strong. And correlated products to indexes, like the Aussie was strong. NASDAQ was up 12.5% last month. Russell was up 10.3%. On the downside, there wasn't much. Crude was down 4%. So, with that, we're going to turn it over to you, Mark.
Okay, so the big thing that I think people want to get is background that's really important here is, we're in a extreme tightening cycle, and the best thing that we've found that estimates the neutral rate, we've done a lot of testing with a bunch of students, a PhD candidate students did a big research project on it, and really very clearly the one that is really the best consistently is just the market 2-year yield. And that's better than a Taylor rule. It's better than all kinds of estimates. What I would say is the Fed on average expects that the neutral rate is about 2.5%. Right now, the market 2-year yield is 3.24. So I think the Fed is underestimating what the neutral rate is, and realize that we have not had a decline in any time the Fed is trying to tighten to dampen inflation. We've never had inflation come down without the Fed funds rising above the 2-year yield by at least 50 basis points. So think about that. That means at this point, Fed funds is going to have to go to about 3.75, 4. That's a lot higher than the market was discounting last week before the labor report. Well, then last week before the labor report, it had the Fed funds peaking at 3.3 and coming down pretty sharply. So it's quite possible that based on historic stuff that generally happens, that they're going to have to tighten more than they're thinking to really get inflation under control. And that probably means more pain. The other thing that we'll talk about as we get to it is that whenever we've had inflation that's high, above 5%, actually what's needed to happen is that the Fed funds rate needs to go above the inflation rate. Okay? So, for example, this is probably a really good kind of estimate here. This is the first sort of when you got a pop in inflation in the late 60s, and you had some fake outs in inflation. where it went down for a couple months and then came back, went to new highs. But really, inflation peaked at about, high fours. And look where the Fed funds had to go. It had to go above 7. Okay. And every other time that inflation peaked materially for at least cyclically, and that's not even doing it beyond the cycle. The Fed funds rate was 1% or higher above, generally 2% above the inflation rate before you got that come off in the inflation rate. And then, of course, when they finally dampened it, you had inflation coming down from 10, the Fed went to 17.5. And then even after inflation started down, they went back up to nearly 20%. So there's decent idea that based on past historical inflation cycles and based on past recoveries, the Fed still needs to go more. And the market has really been sort of discounting that we're going to get this pause quickly. And Powell fed the problem because after the last meeting, he said, well, most of our work may be done. And the market really seized on that and gained that rally. But it seems quite unlikely that we're going to get, now we have entrenched in inflation before we got the Russian crisis, before we got really entrenched inflation with the labor market really going and all kinds of things feeding inflation. Yes, I think that it's quite possible that you could have had soft landing and could have had a quick end to inflation, despite the massive 40% increase in the money supply over the last couple of years. But with natural gas prices exploding, that essentially natural gas is sort of like the new oil. That's where all the countries were sort of shifting their carbon-based energy consumption and energy production because it's cleaner, and they are transitioning to green. So the natural gas problem with Russia came at the exact time that it created the essentially very similar to an oil shock. So we've got that problem that's not dealt with. As we'll see, natural gas prices are popping up again and not that far from their highs. And then we've got food price inflation, not just grains and other things that have backed off, but a lot of different food. And then the big one that we had with the labor report, you really want to understand, is wage inflation has really taken off and spread. So all those things lead you to expect it's not going to be that easy as it has been for the Fed. They're going to have to tighten more than they have before to really try to get inflation to turn, most likely. So you'll realize that, yes, we could have a financial accident, and we could have a much deeper recession happening faster than they think that would lead them to shift earlier than they would have to do. But both of those things would be stock market negative if they happen. So realize that the likelihood is they're going to have to tighten more than the market's been expecting in this rally. All right, the other thing that I think has gotten clearer is the likelihood of recession is going up and up and up. And here's the 210 yield curve, which has been inverted, and it's getting more and more inverted. And here's the 3-month 10-year. And the 3-month 10-year actually touched inversion last week for the first time. So typically when you get inversion in both of these with a very high reliability, since World War II, you've always had recession eventually following, and then realize what this really means. Remember, we call this the brake in the gas pedal of bank lending. When we have an inverted yield curve like this, what it means is banks, it's not profitable for them to borrow from depositors short term and lend long. And so they don't. So we have this situation where the economy is already starting to weaken some, arguably historically before just recently, a two quarter in a row negative GDP was considered recession. All right, they've changed the definition, and there's a lot of things that are strange about this. The labor market is much stronger than normal by some metrics and some other things. But bottom line, we're looking at something that's likely to create a recession if we're not already in one. And we're looking at inflation that seems to be much more entrenched than the Fed is expecting, which is consistent. The Fed all along has been underestimating inflation. And that's kind of what happened in the 70s. Fed just kept thinking it was going to be normal with just a little bit higher inflation. And it's harder to get inflation under control when it pops over 5, and now we're arguing with 10. Think about it. The Bank of England just said it doesn't expect inflation to peak into the fourth quarter at a rate of 13%. Now, Europe has higher inflation than we do, and they're going to continue to, because natural gas prices there are different than natural gas prices here, where it's a big product of ours, and so they're 5 times higher. So that really fuels their inflation a lot. But think about what inflation not peaking until the fourth quarter really says about inflation worldwide. All right, the other thing we want to watch really carefully is the bond market. We talked about how we're coming up at this long-term, this is a multi-decade trend down in interest rates. This is a 10-year rate, and we talked about how it was likely to pause here approximately, went a little bit above it briefly and came back down. That represents this rally in TLTs, and we've had this kind of head and shoulders building. We tried to break out and kind of go back into the range. What you want to realize is we really want to see whether TLTs and a 10-year rate really moves beyond this level of early August, or if it moves below the level of mid-July. That either one of those kind of give us an idea what the bond market is most concerned about. If the bond market continues to rally, closes above this level here from early August, it means that bonds are starting to get more concerned about recession than they are about inflation. If we move back under the mid-July lows, it means that bonds have kind of negated their breakout. And remember, most false breakouts occur when it's against a higher time frame trend. And so that's telling you that bonds are getting more and more concerned about inflation. It's going to be a problem for the Fed. It's going to be a problem for the market. All right, let's take a look at the S&P. The S&P is up here. We talked about this up 4,100 to 4,220 being really key resistance, and we're at it now. And so there's sort of one more level we can go to if the plurality of all kinds of breadth and all kinds of internal indicators doesn't turn higher. We can still go up to this downtrend channel, this 200-day moving average, and that could be the last potential resistance level. But this one here, this 4220, is very important right now. And what you want to realize also that we're going to talk about a little bit more is that so far in this bear market or major correction, every time you've had any kind of a peak, there's been a 5 to 13 day either double top or head and shoulder top on a daily chart, just a short term, one of those two topping patterns. Okay, so that's what we really want to be watching for. And generally the breakdown of that pattern is coming on either 80% down volume or at least 70% with really high volume and strong sort of volume traction. So we want to be watching for that either here, or if we happen to get back up even beyond this, if we get a positive move out of the CPI report next week, which is possible because inflation is going to be down some. But we really want to watch this next level, and we want to keep watching for this 5 to 13 day type of topping formation that breaks down on really strong volume traction to tell us, okay, this could be the start of a new leg down in the bear market. Taking a look at major internals, they're still negative overall with pretty strong plurality. The advanced decline line is flirting with its long-term moving average, but it's not above its downtrend channel. None of the others are above their moving average or their downtrend channel. So that's all pretty negative. We haven't really had strong follow through from the McClellan and the ratio adjusted summation index or anything else, or the new high, new lows to tell us that this is really catching. Now we're getting a lot closer, so we really want to watch things carefully.